In this video, I'm going to share my June update on my Tfsa Dividend stock portfolio that has outperformed the S&P 500 over the years. I'll share the 22 holdings I have and which stocks I purchased with my dividends during the bear market. Let's do this! For those that don't know, my wife and I do our finances together. We have 3 accounts through 2 brokerages, Scotia iTrade and Wealthsimple. And as you can see on my Wealthika account, the month of June has been rough. Like it has on all of us. We're now down 10.2% from our highs earlier this year, and that's including our dividends being reinvested. I think the markets will continue to get hammered. And guess what? I love it. That means I can drip and buy more shares at prices I like for those high quality stocks I want to hold forever. Now let's start with the first of our 22 holdings. VFV, Vanguard's non-hedged S&P 500 index ETF. We hold VFV because it gives us more US exposure and adds stability to our portfolio. Plus, the 0.09 MER is a reasonable drag on the account. On a side note, I'll take VFV over VSP, the hedged fund, since VFV has outperformed to date. I hear that's a common question among Canadian investors. I bought a little over 1 share at the beginning of the month for $92.77. If I held off for a few weeks later, I could have snagged it for $86 or $87, which is the price I started taking this position at. These market conditions really show why trying to time the market is a losing situation. Over the years, reinvesting my dividends has always proven to be better than waiting on the sidelines to buy at the right time. Right now, it just makes up 0.5% of our portfolio. I'll be growing the position to about 5% in the near term. Our second largest holding is still Power Corporation of Canada at 7.9% of our portfolio. This has tanked in the month of June, down 10% and down 25% from its September highs. As a holding company, Power Corporation's NAV is huge compared to the stock price right now. I'll continue to drip as long as they keep growing those dividends as they have for the past 7 straight years, and I expect them to weather this downturn with ease. Next up, we have a mid-cap utility and Capital Power Corp at 7.3% of our portfolio. This is definitely a risky position for us as it is a newer independent energy producer, but one of my favorites. It finished the month relatively flat considering the market crash. However, it did make a new all-time high mid-month. They're targeting a 5% dividend growth for the next 4 years, which is below their trailing 5-year DGR of 7%, but still in line with our strategy for growing our total return. Because the stock price has really gone up recently, dropping this below a 5% yield, we have turned off DRIP at the moment. At 7.2% of our portfolio is Bank of Nova Scotia, down 10% this month and 20% off of its February all-time high. BNS is back to being a low-return, high-yielding bank. I rotated a lot of cash into her before. BNS has been paying consistent dividends for over 100 years, and there's no reason that that's going to change. Just last month, their distribution increased another 3% after an 11.1% increase at the end of 2021. So I bought 1.2919 shares this month at an average price of 76.03. The timing was really fortunate, I have to say, and I hope the price stays depressed in July so I can drip more shares at this price with its PE in the low 9s. I'd say that is great value for this bank. Next is TC Energy Corp at 6.9% of our portfolio. I love that they've grown their dividends for 21 years, and over the past 20 years at a 7% rate, as I mentioned on my portfolio reveal. Just recently, they lowered their expected future dividend growth down to 3 to 5%. This has forced me to put the brakes on DRIP because it breaks the rule of 12 I go by. TRP hit new 1-year highs and a stock price that hasn't been seen since 2020 crash. It has pulled back about 8.5% since those highs. The yield isn't where I like to see it to drip shares at the moment. I am interested to see how well it performs in this turbulent market though. Next up, we have First National Financial at 6.8% of our portfolio. As I admitted last month, I added to my holding at the wrong time, dollar cost averaging up way too much, only for the stock to drop again more in line with where I think it should be valued. They have done amazingly well over the past few years and raised their dividends again to keep the streak going. They also gave a 5th consecutive special dividend last year. I do not believe there will be more than a 50-cent to 60-cent special dividend this year. Of late, they've had some difficulty with the changing market environment in Canada with the rising interest rates. I have strong conviction that their team will continue to grow and capture more of the Canadian mortgage market and grow the dividend at the 7% they have over the past 10 years. The stock has been trading down 10% in June, and down 36% from the highs of last year. I decided to continue to reinvest my dividends into it, as the PE is where I like to see it, in the high 9s to low 10s. I bought 7 shares at an average price of $32.92, making for a healthy yield of 7.1%. Then we have BCE Inc. at 6.6% of our portfolio. This is a core holding of our TURF model. They have recently raised their dividends 5.1% and have been growing them for 13 straight years. I love telecoms in Canada, as you well know, and they have this huge impenetrable moat and pricing power to perform well in an inflationary period like we're going through. The stock, like many others, is down 8% in June, and down 14% from their April all-time highs. I hope to drip some shares if the price continues to hover in the low 60s. Next is ENBRIDGE at 5.5% of our portfolio. The stock price has dropped 8% since the beginning of June, where it set a new all-time high. The energy sector is of course really enjoying a rally during these high oil and gas prices. I do not see this lasting for years. The cycle will come to an end, eventually. Even with the pullback, I won't be adding any shares, and I did not drip this June. Next up is another utility, ALGONQUIN Power and Utility Corp, which is our renewable energy play at 5.6% of our portfolio. The price has slid 5.5% in June and is now down 13.5% from its April highs of $20 a share. As a utility stock that's been raising dividends for 11 years straight and over the past 5 years at a rate of 7.5%, I'll continue to take the drip discount they give on their shares. As a very diversified and well-managed company I believe in, I'll be dollar cost averaging down even more. I hope the price can stay down until their July 15th payout. In the meantime, I used some dividend paychecks to buy 4 shares at $17.21. Woohoo! Just in time for another dividend check. At 5.1% of our portfolio, we have PEMBINA Pipeline Corp. This is a stock I've been contemplating cutting from the portfolio, as I mentioned last month. They haven't grown dividends for almost 3 years and have a 5.8% 5-year DGR. There are rumors of a ½ cent to 3/4 cent monthly dividend increase in the works. This is the smallest of the 3 pipelines we own. With what has happened in Europe, I'm fully convinced that gas and oil are here to stay for my lifetime. PPL hit an all-time high in June, but still finished the month down 10%. Even with the pullback, it is still too rich for me to add any more to my portfolio. I like to see what management does with their cash flow to grow the company. Next is our last utility, FORTIS, at 5.1% of our portfolio. Another staple in most dividend growth portfolios, right? It has grown dividends for much longer than I've been alive, 48 years, second most in Canada behind Canadian utilities. Its 20-year DGR is a healthy 7.7%. It is well diversified, it has a stable revenue stream with good, solid, continued growth due to reinvestments. Dividend growth is pegged at 5% in the coming years. FORTIS has had a major run-up lately, hitting an all-time high at the end of May, only to capitulate with the rest of the market in June. It has since rallied back, but it is still down 3.5% on the month. At this price, I didn't drip any shares. If it trades under $59 again, I'll turn my drip back on. Next, we have our first REIT, SmartCentres Real Estate Investment Trust, at 4.9% of our portfolio. This is another staple in our TURF portfolio. REITs won't ever fit the rule of 12 I have for myself. They are here for stability with $11.7 billion in assets. I like SmartCentres because they are anchored by Walmart. And as I like to say, we all know Walmart isn't going anywhere anytime soon. They had some trouble during the past 2 years. However, they have been slowly increasing their pipeline of projects from shopping centers to city centers. They have some prime properties in major cities. They had a 10% pullback in June, so I dived in for a few more shares with one of our dividend paychecks. We bought 4.3 shares at $27.27 per share. If I had held off for another few trading days, I could have grabbed it for 3% less. But then again, as I always say, a bird in hand is better than 2 in the bush. Take what you can get when the value is right, or we may always hold off for just the right price and never invest. Next is Great-West Lifeco at 4.2% of our portfolio as a solid large cap. I just love how diversified they are for revenue streams divided between Canada, US, and Europe pretty much equally. They've been steadily growing their dividends for 7 straight years, just like their parent company. Well, it dropped with the market in June 9.5% and is now down 23% from its all-time high in February, before the whole Europe situation happened. I couldn't help it, so I dripped a few more shares at a little over $31 a share. Next is MANULIFE Financial Corporation at 3.8% of our portfolio. They are very diversified with many streams of revenue and have a very large presence in Asia. Their share price has struggled since the financial crisis, which doesn't bother me one bit. We're in the accumulation phase of investing, so the 5% drop in June was a lovely thing for us. It is now trading 21% off its February highs that were last seen before the financial crisis. I look to add to this position as the PE is well below the historical average, in the high 4s if you can believe it. For that reason, I grabbed 6 shares at an average price of $21.36. I still believe in Manulife's ability to get back to the pre-financial crisis profitability. Next up is TELUS Corporation at 3.7% of our portfolio. This telecom is the better performing of the two we own. It has done exceptionally well at diversifying its revenue, spinning off TELUS International. They just again raised their dividends and have been doing so for 18 years, at 8.7% over the past 10. This stock, like almost the whole market, pulled back 9.5% in June, and is now off 16% from its April all-time highs. It got close to its 52-week low in June. I've been wanting to add to my position to get it closer in line with my BCE holding. Sadly, I had no cash in my TFSA to deploy at the time. There's always the next payday though, right? Then we have a small cap asset management company in FIERA Capital at 3.7% of our portfolio too, just like TELUS. They have a 5-year dividend growth rate of 6.4%. Their assets under management though have dropped recently, really hurting the stock price. I still believe they're capable of maintaining the dividend. Growth in the future seems slim though, but with that yield, I can wait. I'm deciding what to do with them in the near future. The price dropped 5% in June and is now down 20% from November. My eye is on this one. Canadian National Railway is our only industrial stock at 1.6% of our portfolio. CNR fits the rule of 12 I go by, increasing dividends for 26 years straight with a dividend growth rate of 14.2% over the past 10 years. They are one of the two big players in the railroad industry in Canada with an impenetrable moat. As a defensive stock, the price was flat in June, but is still down 14.5% from their March highs. I bought $3.78 worth for 0.0254 shares. Every little bit counts, ladies and gentlemen. Next is my favorite bank in Toronto Dominion at 1% of our portfolio. This should be much larger, however I trimmed it when the stock price was over 100 and I just couldn't see the rationale for it. I'm looking like a hot shot now that the stock is down 20% from when I sold it. This does go against my rule of not trimming my winners, but I just couldn't justify the price. TD is the best run bank in Canada in my opinion and has a huge presence in the US. It has a 5-year DGR of 7.9%. I expect another raise to come at the end of 2022. I look to add more again in the low 80s. Next is our last bank in Canadian Imperial Bank of Commerce at 0.9% of our portfolio. This is another bank that I trimmed during their all-time highs. Some got excited by the 2-for-1 share split. I didn't. This is the smallest of the original Big 5 banks and is heavy into real estate. This is another reason I decided to trim my holdings here. And like TD, my wife and I look like hotshots. It was pure luck. Everyone knows timing the market is impossible. I feel the Canadian real estate market will be depressed for some time now with the rising interest rates, and this is going to lead to less mortgage originations and less revenue. They are still a very solid dividend grower at 5.4% over the past 5 years, and I plan on adding to my position again since they are down 25% from their all-time highs with a good PE of under 9. And lastly, our smallest and newest position at 0.5% of our portfolio is GOEASY Ltd. They're in the credit services industry. I was skeptical of them at first as a high-growth small-cap stock in the financial sector. After that major pullback this year and continued growth, I looked into their business model deeper and was convinced they have a large door of opportunity given the rising interest rate situation, high inflation, and a big buffer with the leverage they use. They were down again in June 14.5% and are now down 37% on the year. I took the opportunity to grab $32 worth for 0.3135 of a share at an average price of $102.07. I don't like to mention it, but CANOE EIT Income Fund is making up 1.8% of our portfolio. I like its holdings, I like its diversification, and I like its fund manager. I've been just enjoying the distributions and reinvesting them elsewhere. I'm not an income investor and I have no plans of it. At some point, I will divest and put this capital to use in a high-growth, high-conviction dividend stock. And just to mention, it is now down 14% from its April one-year highs. And still, our largest holding is RIOCAN Real Estate Investment Trust at 9.4% of our portfolio. I added a lot during the 2020 crash to bring down my cost average, not expecting the distribution to be cut in early 2021. They have $14 billion in assets and a ton of properties under development in the Toronto area that will add to their AFFO. In June, this bad boy dropped 11%, at one point as low as 14%, and is now 22.5% off its March high. I dripped 2 shares at $22.10 and bought 0.07636 more shortly after, as RIOCAN forms a large part of my safe and stable real estate part of my TFSA portfolio. So there you have it, all 22 of our holdings and what purchases we made this month. We deployed a total of $831.42, adding $47 to our forward annual dividend income this month. No fresh cash was added, of course, as I maxed out our contributions in January. Thank you so much for watching and ever so gently smashing that like and subscribe button to help out the channel. I hope you found it interesting to see what I'm doing with our TFSA to grow dividends safely for tax-free cash flow. And before I leave you, here's some footage of what we've been up to over the past month in Vancouver. Until next time, I'm Mr. Financial.